Welcome back, dividend and value investors. As many of you know, the US dollar is very strong right now. Hence, it should come as no surprise that I'm starting to look a bit more into European dividend stocks again. On one side, a strong dollar has blown up our portfolio values by at least 15%, but please don't count yourself lucky yet, because if the dollar would go back to $1.20, let's say, then in my case, I would lose the equivalent of 1.5 years of dollar cost averaging. The same applies to my projected annual dividend income. My dividend income year to date is really high, but I'm not sure if we will see the same going forward. We might be climbing a steep hill to reach a proper year-over-year dividend growth again, if the US dollar would revert to where it was last year. On the other hand, US stocks became much more expensive than they were a year ago, of course from a dollar point of view. Luckily, we are still benefiting from the overall 25% decline since last year, which in reality means that we are approximately 10% better off if we take the 15% higher cost in dollar exchange rate into consideration. Of course, if you are a US investor, then most of this means the opposite to what I have just mentioned. Hence, maybe this is just the time to get some more bang for the buck by considering some European stocks. Having said that, and before we get started, please consider the stocks that I will be covering today as an inspiration for you. I would always suggest to do your own research. The stock market is down year to date, and for many people this is a hard pill to swallow. I've seen time over time that conviction can't be copied from, for instance, financial influencers on YouTube and other social media channels. Conviction usually comes from doing your own research and truly understanding what you have in your portfolio. Hence, if you like any of these stocks that I'm going to show you today, why don't you just read the first 30 pages of the annual report and read some customer reviews to get a better understanding of the business. If you still like it by then, have a look at the financials to see if it's really worth owning for you. Okay then, enough preaching for today. It's time to hit the like button or the subscribe button, and let's get started with the first European dividend stock. So the first stock that I would really love to share with you is Thule. Thule Group declined 27% over a single year. If you don't know this company yet, this company is famous for its outdoor adventure systems. Think about all the roof boxes that you see in the car when you go on holiday, and think about all the bike racks that you see around there. This is truly an iconic Swedish company, and actually I know it already as long as I can remember, at least from my adult life. It's a top-notch company known for its high-quality products. And the great thing is, this company is really in an up-moving trend. Just a few weeks ago, in the beginning of May, the company also announced that they will enter the car seat as well as the dog transport product market. This is really good news because I think the current car seat market is really long overdue for a challenger. And I believe this is a really good fit for Thule when you think about product markets. And people that have been following Thule are not surprised by this, because their long-term goal that they have recently announced is to double their sales by 2030, because now they are approximately at 10 billion sales and they want to go to 20 billion sales in Swedish crowns. At the same time, they've also updated their dividend policy and they want to pay out the 75% in dividend related to the net profit. Now you need to know here, this is not showing a dividend growth policy. Hence, be aware that this company might cut the dividend in the future, but at least you can expect a high dividend in relation to its profits. However, if history is a guidance, we can see that the company has just been doing this really well. It has been growing their dividend over time, although in 2020 it was very conservative and it has postponed the dividend at the time, but they included the dividend that was announced to the shareholders in 2021 to still give them the cash that they deserved. You know, it's not so nice because in 2020, if I would have depended on that company for my dividend income, it would have disappointed me really a lot and I would have been in severe cash flow issues. If you think about it from a diversified portfolio point of view, I look a little bit different than this. I could have one or two stocks that do this to me in a crisis. However, only by clear exceptions. The great thing here is that Thule is really a great company with a lot of industry tailwinds, and I don't see them going away anytime soon, and I honestly believe that the 20 billion in forecasted sales by 2030 is quite reasonable. So if we look at this company from an overview point of view, what you can see because of the dividend cut, of course, that it has only a track record of 2 years, but the dividend yield is currently 4.5%. In my opinion, this is a really nice entry level to start investing into this stock. The 5-year dividend growth rate shows only 3.6%, but that is because it's looking at the 10.90 here. Remember, there was a special dividend into that. Otherwise, we're talking really about a 31% compounded annual growth rate for Thule, which is amazing. We need to look a little bit at free cash flow payout because currently the company is in the minus for free cash flow. And they have also mentioned that here because to meet growing demand and to optimize supply disruptions due to shutdowns, component shortages, etc., inventory has been built up, which has increased working capital. This is really it. They are taking costs forward and they are paying now for it, and that's why they have a negative free cash flow. So expect if they start selling inventory, the cash outflow will not be there anymore. So probably next year or the year after, we will see super duper major free cash flow coming in because of this. So this is really bookkeeping what we are talking about today. Now, having said all of this, I'm quite bullish on this company. It has a value creation metric of plus 15%, meaning the return on invested capital is 15% more than the cost of capital. This is really, really what we love to see. And the debt to equity is 40%, which is really, really healthy. Now, for this one, I have used a net income of 1.3 billion. I feel this is relatively conservative. In 2021 and 2022, it's around 1.8 billion. Hence, the 5-year average is around 1.3 billion. But let's face it, this company wants to grow to 20 billion, so it will grow at a fast pace. That's why I'm using a 9% growth rate over the first 5 years and 7% thereafter, which is really not that far off from their ambition. However, the margin of safety is really in the net income figure that I'm using. Use a terminal multiple of 15, and I believe that this company should be trading between 240 and 250 Swedish crowns. It's currently at 287, so it would still need to decline by 15%, but by that time, maybe consider me a buyer. So this is Thule Group, I think a really great European company for your consideration. Let's go to the next one, and the next one should be quite familiar to you. ASML. Not too long ago, I did a deep dive into this company, and I will put the link to the video in that description here. Since then, the company has declined by 25%, so you could argue, hey, eDGI, not the best pick that you are making. I get it. You know, I can't time the market. The chip industry has some supply chain issues, but you know, for me, ASML is a monopolist. I don't know any competitor. It is really providing the shovel to all the people that are looking for the gold. This is for me ASML's position in the sector. Currently paying a really low dividend, but the dividend growth has been really extraordinary. If you don't know ASML, effectively they create what you call DUVs and EUVs. So it's the only EUV manufacturer at the moment in the world, supplying the machines to, for instance, TSMC in Taiwan, but also Intel. And Intel is one of the first designated buyers of their latest machines coming available in 2025. So also the relation here between Intel and ASML is really interesting. So a clear monopolist in this space. At the same time, what is also pressuring the price is that Bridgewater, from the famous legendary investor Ray Dalio, is short European stocks. And with this also short on ASML. He's clearly seeing something that I'm not seeing. Maybe it has to do with the dollar, I don't know. And secondly, also there is lobbying from the United States to put pressure on ASML to stop selling chip-making machines to companies in China. We're talking here about approximately 15% of sales of the DUV machines, the more traditional machines. In my opinion, the growth of EUV will easily outpace the decline of potential revenue coming from this business unit. Having said that, I believe that ASML is really a great company to look into, and I also believe that it's fairly valued right now. Because if we look at it, at the time, I put the fair value around 640 euros. This is quite aggressive because I'm taking here a 6 billion free cash flow going forward. They did last year 9.9 billion. This is a lot, but there are some one-offs in there. However, the real bullishness for me comes into the growth rate, 20% and 12% thereafter, at a multiple of 18. should give me around 660. You can see if I'm bearish, I'm looking only at a 12%. For other stocks, this is still really high. I'm never using these numbers. But look at the growth rate that we have been seeing over the last 5 years, 33%, 50%, and I don't see this stopping at the moment. That's why I feel that I'm still relatively conservative when it comes to ASML. As you can see, the shares are currently trading at 442 euros. Full disclosure here, I own something of ASML already and I have a buy order outstanding for ASML at 400 euro. Why then? Just because it's a round number, nothing specific. I could buy it also today. So this was the second European stock. Let's go to the third European stock, which is actually from another sector again. And in this case, I'm talking about Allianz. I keep coming back a little bit to this company. It's currently down 15.7%. While less than the others, it was already struggling a little bit with some issues that it had. It had a certain fund for teachers that blew up during the pandemic. They are being penalized for that. They have some fines coming up there, or actually they reserved those already. But you know, who doesn't love the juicy dividend of 6%, which in my opinion is fairly safe. I don't see Allianz cutting the dividend anytime soon, and at a PE ratio of 16, I think this company is well positioned to grow my dividends far into the future at a reasonable price today. If you don't know Allianz, really quickly, they are mainly in the property and casualty insurance business, life and health insurance and asset management. I actually also buy a lot my car insurance from Allianz as an example. It is the largest insurance insurer of the world and is currently paying 10.8 euro in dividend. And as you can see, during the pandemic, they decided to freeze their dividend. One of the reasons for that was that governments in the European Union were recommending strongly insurance company to either cut their dividend or to freeze their dividend. Hence, that's why we didn't see any dividend growth at the time. Now, if we go to my one-pagers and my analysis as an overview for Allianz, you can see a nicely rising dividend, already a dividend growth of 13 years. It had to cut it a little bit during the great financial recession. The company is way more better positioned nowadays from a balance sheet point of view than it was back then. So also here I feel much more comfortable. The company currently has a net income of 6.6 billion. This is the real number that we need to look at, not the free cash flow. The free cash flow is a little bit misleading here due to the way the business operates, because it's getting a lot of cash flow from the operating cash flow, but they also need to invest a lot of that. And that's why free cash flow is not the right metric for an insurance company. I took a growth rate here of equal to the free cash flow itself of 6.27%. Thereafter 3% after the first 5 years at a discount rate of 10%. I believe the company is worth somewhere around 250 euro right now. It has a really strong balance sheet with a credit rating of AA3 and a nice debt to equity of 40%. For me, this company is doing really well. A Chowder rule of 13 because it has been growing the dividends with 7% over the last 5 years. Hence, I find this a very attractive company at the moment in time with a really juicy yield. Now, the fourth company that I would like to show with you is good old Siemens. It's the second German company in this list. It's currently down year to date 25%, like most of the others as we can see, and trading around 96, 97 euro right now. Now, what I like so much about this company is that it's really a great play on everything around sustainable energy and growing population. You know, the urbanization of cities and such. Siemens has all the equipment to support us as a society. And these are all strong tailwinds, I believe, specifically in mainland Europe. So as an example, the trains, the tramways, everything that we need and countries are investing in there. Siemens is really a leading company in the industry. But also think about all the medical equipments and actually also still ownership they have in other companies. So also wind turbines as an example. Siemens is also in this area available and you will have exposure to this. For me, this is one of the last remaining industrial companies in the world that is actually executed very well and really shareholder friendly. From that point of view, if we look at Siemens here, I believe that the fair value is around 136 euros. I do this based on a cash flow that I'm assuming here of 7 billion. You can see it's approximately the 5-year average that we are seeing, and the company is also growing more than that. So I still think there's some conservative estimates in here, and maybe with the recession now it will get a little bit less orders, so we might see it declining as well. But I think 7 billion as an average baseline is fair. It's not a fast-growing company as we saw with ASML, so 6% in the first 5 years and 4% thereafter at a terminal multiple of 14. I think is quite conservative. This gives us a share price of fair value for 136 euro, while it's trading currently at 97 euro. Now, if we zoom out, right, and we look at the max of Siemens, you can see that this is also a little bit of a cyclical company. You can see during the pandemic, it was at 110 euro before, and it dropped all the way to 65, 70 euro. This can still happen right now, right? It can go to 80 or not, but I generally believe that we're talking about a fairly valued company or an attractively valued company under the 100 euros when we are talking about Siemens. And I'm actually considering this month to use some money to up my position in Siemens. And if it goes back to 70 or 80, consider to see me buying much more. Just know it's cyclical of nature. Buying it at the top at 147 for me was clearly overvalued. Now might just be a good situation to start nibbling in, and if a recession comes, I'm sure we will see better prices going forward. So the fifth company then is actually little known in the FinTwit and investing community, but I would love to share it because I recently started a position in this, and this is Ambra. If you don't know Ambra, Ambra is the first and only Polish company that I enjoy investing in. It's currently 4% down year over year. So not too much, but there's also little volatility in the stock or little volume in the stock. It currently pays a dividend yield of 4.6%, which in my opinion is really interesting. Now, if you don't know Ambra as such, it's a company mainly operating in Poland, Czechia, Slovakia, and Romania. I mean, I always like to say, your body is a temple. You gotta fill it with spirits. And this is exactly what Ambra is doing, because it's really well known, specifically in Poland, for some of the lower budget wines like Prosecco, Zin and Sin. Many people buy this around New Year's Eve. My kids love Piccolo. It's the non-alcoholic champagne for them, but also El Sol and Cider. Cider is really popular over here. So I see this brand everywhere. It has been rapidly growing. And so have been their dividends, because which Polish company can really show commitment to the dividend from 10 groszy back all the way in 2008, 2009 to 95 groszy right now. For me, this is amazing, and I'm glad that Piotr, who I met once also face-to-face over here in Warsaw, recommended the stock to me, because I'm now finally a happy owner of this one. There is, by the way, still a note that I want to share here, because if you're an owner of it, you have really a minority vote, because only 29% of the shares are tradable on the stock exchange, because Schloss Wachenheim from Germany owns 62% of the shares currently hold in Ambra. Now, so far so good. I'm sure that some of you are surprised by this pick, but I really wanted to show you that. Let's also have a look then at what my dashboard tells me. As you can see, the dividend growth is coming back again here. If we look at free cash flow, it's around 21 million trailing 12 months, but over last year 90. What you can see, it's not stable. Earnings are way more stable, and there are good reasons for that, because they have been investing a lot. That requires upfront investments, hence why you see this in the free cash flow. Dividend growth 13 years, like I said, a good starting yield, 12% dividend growth over the last 5 years, so chow the rule of 17 or 18. This is really high, and that's what I also love about this stock, while still giving me a really decent payout ratio of 45%, which means there's still ample room to grow the dividend. Forward PE of only 10, which tells me that this company is really trading cheaply at this moment, while revenue was growing 26 and EPS was growing 25%. If we look at it from a debt to equity, almost no debt, although I would love to see a little bit of a better performance on the return on invested capital. Currently it's trading at 20 zloty and 40 groszy, and my fair value is 23 zloty. How did I get there? I took a 40 million zloty net income. As you can see, probably around the 5 years average. However, I expect the company to still have decent growth going forward of 8% and 5% thereafter. I'm a bit more conservative here because I'm not an expert necessarily in the whole supply chain in Poland, hence why I took a 12.5% discount rate at a terminal multiple of 14 gives me an average fair value price of 23 and 28 groszy. Expect me to accumulate more shares in this. It will be a tier 4 company for me, which means maximum, let's say, 1% of my entire portfolio. But hey, that doesn't stop me from still accumulating quite some shares in this company. And my initial buy was like a few weeks ago at 19 zloty. Expect me to buy more if it touches that price again. Guys and ladies, these were 5 European stocks that I believe could do you really well in your dividend portfolio. And the nice thing is, these are trading around fair value, slightly above fair value, or others really with a margin of safety. And you know, it just avoids you at this moment in time to buy some US dollar traded companies like the typical classical American dividend aristocrats. Hence, today I've shown you 5, maybe not always so obvious alternatives. Take it as your consideration. And for now, see you next week.